You're sitting on silver right now. Maybe you bought it at 40, maybe at 50. Maybe you got in at 65 and you're watching it climb towards 73 an ounce or higher as we head into late December 2025. And there's this voice in your head asking the same question over and over. Do I sell and lock in my gains? Do I hold and see where this goes, or do I buy more while everyone else is getting nervous? I'm going to tell you exactly what I do, not what some talking head on CNBC thinks, not what your neighbor who just discovered investing last week believes, what I would actually do with my own money. And I'm going to walk you through my exact thinking the same way I've approached every investment decision for decades, through rigorous quantitative models and pattern recognition. Look, I've seen this movie before. I lived through wild commodity swings from oil futures volatility to metal squeezes, and I've watched precious metals mania play out time and again. I've been around long enough to know that when everybody's talking about an asset at cocktail parties, when your barber's giving you investment advice, when the price chart looks like a hockey stick, that's usually not the time to be greedy. That's the time to be careful. But here's what makes this different, and I want you to really hear this because it matters. Commodities like silver can offer mispriced opportunities when the data screams imbalance, but they don't produce cash flows or dividends. They rely purely on supply, demand, and momentum patterns my models have dissected for years. Back in my early trading days, I experimented with commodities and futures, building systems to spot non-random sequences in prices. People thought quantitative approaches to markets were madness at first, but the fundamentals can be screaming when data shows structural shifts. For silver, the numbers were clear: industrial users consuming more than miners producing, inventories drawn down relentlessly. It was mispriced based on hard supply-demand data. I held positions when the math supported it and exited when patterns normalized and fair value appeared. No regrets. That's how I invest, cold, data-driven, no emotion. So let's talk about today. Silver hovering around 73 in late December 2025 after a massive run fueled by deficits and speculation. Is it a buy? Is it a sell? Is it a hold? Here's how I think about it. First, I always start with the facts, not opinions, not predictions. Facts. According to the Silver Institute's latest data, the global silver market remains in a structural deficit for the fifth consecutive year in 2025, with demand outpacing supply by around 117 million ounces, depending on the estimates. Total demand sits around 1.12 billion ounces, while supply hovers near 1 billion, including mine production flat at roughly 20 million ounces, and recycling filling the gap, but not enough. Now, here's where it gets interesting. Industrial demand alone drives the bulk, accounting for over half of total usage and hitting record or near record levels. This isn't hype, it's structural. Solar photovoltaic cells require significant silver per panel, and global installations continue expanding rapidly as renewable energy pushes forward, consuming hundreds of millions of ounces annually despite some thrifting and loadings. Electric vehicles demand far more silver than traditional ones, 50 grams per EV for electronics, sensors, batteries, and systems, pushing automotive silver use higher at a steady compound growth rate. Add in 5G infrastructure, medical devices with antimicrobial properties, AI data centers needing massive electrical conductivity, and consumer electronics, and this is real, persistent consumption that won't vanish overnight. Supply is the flip side. Mine production stays essentially flat, with most silver as a byproduct of copper, lead, and zinc mining, meaning you can't ramp it quickly just because prices spike. New deposits are rare, development lags years, and capital costs are huge. So we've got constrained supply meeting accelerating structural demand. That's a recipe for higher prices over time when the data patterns align. But, and this is a big but, we've also got heavy speculation layered on. When silver was lower a couple years back, few cared. Now at these levels, retail piles in, ETFs see inflows, online forums hype it, momentum traders chase. That pushes prices beyond pure fundamentals, creating volatility. And volatility is not your friend if you don't have a clear, systematic plan. So here's my framework, the kind of rigorous test my models would run 3 key questions. Question 1, do I understand what I own? If you hold silver, I know exactly why. Are you betting on industrial growth patterns, hedging inflation via store of value, speculating on a squeeze? Your answer shapes the strategy. I've never been a fan of holding assets purely for inflation protection. I'd rather own things that compound through cycles, but precious metals can serve as a hedge when currencies face pressure, especially with ongoing fiscal dynamics. Question 2, what's the asset actually worth? Commodities lack cash flow, so no discounted cash flow models here, but look at production costs. All-in sustaining costs for mining an ounce sit around 20 EV to 23. At current prices, miners enjoy fat margins signaling a premium above bare costs. Is that premium justified? Partly yes from the ongoing deficit, partly no from speculation and momentum. The data shows overextension when momentum dominates. Question 3, what's my margin of safety? This is the most important question I ever ask. Margin of safety means entering at levels where even if patterns shift, downside is limited. When silver traded much lower and costs were close, the math offered safety. At these elevated levels, the buffer thins. If industrial growth slows, recession hits, or speculators panic, sell prices could correct sharply, leaving losses. So, here's what I would do, broken into scenarios based on your position. Scenario 1, you bought between 30 Ls and 50. You're sitting on strong gains, 50% or more. My advice, take some off the table. Not all, but a meaningful portion. Say you own silver worth $10 and at an average cost of 40, it's now worth far more. Sell half, lock in profits exceeding your original stake. You've got house money left. If silver keeps climbing on fundamentals, you benefit. If it corrects, capital is protected. This is rational, not greedy or fearful. Scenario 2, you bought above 60. You're up modestly, maybe 10-20%. You entered late in the move. At this point, I'd hold but not add. Set a mental stop around 65 or 68. If it breaks lower, momentum shifts. Exit. If it pushes higher, fine, but stay vigilant for weakness. Don't fall in love. This is momentum, not a forever hold. Scenario 3, you don't own any and are considering entry. This is tough. If you lack precious metals exposure and want 5-10% portfolio allocation as a long-term hedge against structural trends, dollar cost average in over 6-12 months. Don't lump sum at these levels. Buy small now. Add on pullbacks to 60 L or lower. The easiest gains came earlier from here. Upside is possible, but risk of sharp correction rises. Chasing rarely ends well. Now, let me tell you what I'm actually doing. I don't hold significant silver positions today. My systems focus on broader patterns across assets where models show edge without commodity volatility. Would I buy aggressively now?
No, not in size.
Better opportunities exist elsewhere in liquid, modelable markets that compound without the same swings. But that's me, quantitative, diversified, low emotional drawdown. Your situation differs. Here's the action plan right now. Pull out paper. Write 3 numbers, your cost basis, current value, original reason for buying. If speculation drove you and you're up big, sell at least half today. If long-term industrial demand convinced you, hold but pause adding here. If considering entry, wait for pullback or average small. One more thing, the biggest mistake is confusing a bull market with brains. Silver's run doesn't make you a genius. It means timing aligned. The test is next greedily hold too long. Panic sell dips or discipline profits and patience for real setups. I've built fortunes and sidestepped ruin by following process. Buy fear, sell greed. Right now with silver elevated and speculation hot, that's your signal. Save this. Revisit in 3 months. Calculate your position fully. Cost, value, 20-30% downside impact. If that hurts financially or emotionally, you're overexposed. Fix it today. Don't wait.